Welcome back to Business Today Television and to our special edition of Market Gurus, where we get you to meet the finest brains that are there on Dalal Street, people and professionals who manage thousands of crores of investor wealth and have over the past 2 decades or more created immense wealth for their unit holders. Our guest today is a gentleman from the PSU mutual fund space. Mr. Yogesh Patil is the CIO of equity business at LIC Mutual Fund. Namaste Yogesh ji, a very warm welcome to you. Mr. Patil manages about 5 equity funds with a corpus of 5,400 crore rupees. For the past 8 years that he has been with LIC Mutual Fund, he has overseen investments in LIC Large Cap Fund, LIC Balanced Advantage Fund, and of course the LIC Mid and Large Cap Fund. There are other funds that Mr. Patil also manages. Before his stint at LIC Mutual Fund, Yogesh ji was for 8 years with Canara Robeco Asset Management Company and has also spent a brief interval at Sahara Mutual Fund. Namaste Yogesh ji, what a pleasure to have you on a day when the Sensex has hit a record 80,000 points. The Bank Nifty is at a record 53,000 points and the Nifty is also above 24,300. It's a pleasure to host you, sir. Can you please describe to our viewers the sentiment at this point of time that is prevailing on Dalal Street, and do the markets look overstretched to you?
Good afternoon, sir, and thank you very much for hosting me on your channel. And regarding the biggest question everyone has, or what is the outlook on market basically? And market always unpredictable, but I'm just making simpler for everyone. India is poised for a booming future driven by several key factors like decarbonization of power, defense spending, fiscal deficit reduction, deglobalization, and government focus on manufacturing will automatically reduce the imports and boost the exports. So this growth is largely driven by capex, with anticipated consumption growth balancing in India in future, and that's the balanced way the India growth story should work basically. And enhancing the manufacturing in India offers a huge benefits, like your dependency go down on imports from other countries. It enhances the basically exports capabilities and contributing to economic growth. It encourages sustainable job creation indirectly and directly. At same time, it controls the balance it makes it helps with balancing the trade deficit and stabilize the currency, improves India's global reputation and significance. It means in short, अगर आप देखेंगे कि कंट्री का जो इमेज है स्लोली इंप्रूव होता जाएगा. मैन्युफैक्चरिंग विल अगेन इंप्रूव, मतलब डिपेंडेंसी रिड्यूस करेगा और दूसरी कंट्रीज से ऑब्वियसली इंडिया का डिपेंडेंस बढ़ेगा. तो फ्रॉम देयर पर्सपेक्टिव और फ्रॉम आवर पर्सपेक्टिव, द इंडिया इज इन बैलेंसिंग, एंड it's actually if you see the recent inclusion of Indian bonds in JP Morgan, it is actually driven by their clients, and a few of the global recognition of India's potential is evident, and it was acknowledged by so many players, and it has actually happened. So that this gives a stability to country, and up to some extent, it is also providing improve the country's image. This will give boost to so many asset classes that includes your equity, FDIs, and this will help the country to grow. So obviously, India's government is also focusing on infrastructure. So investing in infrastructure, FDI doesn't boost directly the equity markets, but it will help in sustaining the equity market and keep balance between consumption and investment. That's how the India story will continue for next 10 years. So I believe there will be challenges over recent run up in valuations, or maybe 6 months could be sluggish. But over a longer time, India is the only country where we see a growth. Not we, everyone sees the growth, and we are heading for so many good sectors and sunrise sectors like electronics, defense manufacturing, railways. There's so many new themes of encouraging. And if you see the gross physical capital formation till date, the last year around 92 lakh crore, which is roughly 40% is your household, and 10% is social. So if you see the total capex plans, including government and private, which is roughly around 90 lakh crore. So for next 6 years, we see a huge capex boom, and that it does have a very positive multiplier effect on economy, on job creation, improving the country's image. At the same time, also stabilize the currency. So bull run will continue, and we need to be choose the stock specific, because which sector do well. There are certain sectors which grows higher than nominal GDP. At same time, there are sectors which grows less than nominal GDP. So obviously, everything is factored in valuations. Where visibility is high, valuations are high, and where visibility is less, definitely valuations are very attractive. So we need to choose a basket to basket, stock specific sector as to be a real, basically, stock picking market.
Right. I agree with a lot of points that you've mentioned. Let's just look at Dalal Street at this point of time. As I had mentioned in my opening remarks, that you have record highs on three main indices, and across the sectoral landscape, many sectors, financial services, the mid cap and the small caps, the auto space, pharma, to some extent even FMCG. These stocks are at 52-week highs, if not record highs. According to you, in the next 12 months or so, how do you see the valuations panning out between large caps, mid caps and small caps? As an allocator of fresh capital every month, where is the bulk of your investments going into LIC mutual fund? Are they large caps, or do you still have how should I say, larger flows moving towards mids and smalls?
So normally, it's all dependent on the opportunity, because the new leg of growth is coming from different sectors, like manufacturing, engineering, capital goods, niche sector like auto ancillaries, electronics, and some of the industry leaders are only present in small cap, mid cap selectively, where the opportunity is very big. uh, and in large cap, most of the sectors are almost matured. So it is also reflecting the earning growth, and mid and small cap also offers a much higher earning growth. But normally we don't decide on basket how much is large cap, mid cap, small cap. We just see the earning growth and the business potential. Some of the large cap sectors have maybe growing less than the nominal GDP, and some of the mid and small cap growing maybe 2x kind of nominal GDP. So we need to bifurcate this growth between small cap, mid cap, and large cap. So when we choose the business, we see the opportunity normally. We don't actually directly allocate directly here. This is the large cap. Obviously, there are some fund compulsions. So to till compliance, we are matching those requirements. But if you ask me, the earning potential and re-rating will continue to happen in good businesses, and those businesses are largely present in mid and small caps.
Wonderful. This is one of the most sensible explanations I have heard in trying to justify the superb fund inflows that we are seeing in small and mid cap funds. Mr. Patil, let's take this discussion a little further. Twice in your conversation so far, you have on your own mentioned the defense space. I'm very, very hesitant to ask a question on this one, but I take this opportunity which you have presented to me on a platter. It's been a blowout. Masgaon Dock up 10 times in 18 months. Cochin Shipyard up 12 times. Garden Reach up 8 times. Hindustan Aeronautics and BEL have also given multi-bagger returns over the last 24 months. We are at a situation where your competitor AMCs are launching sector-specific funds in defense, and again reaping a lot of money and making phenomenal returns. Is this sector still worthwhile to put in long-term money? or are we just super overheated and we are just in that game where you just buy and forget about it?
Nothing called buy and forget. We need to again see the segment wise, right? Which segment offers a much higher growth? Because in India, defense, see, normally historically, see that 80% of the defense equipment actually we import. So we are not seeing the higher earning growth, and we need to see how much company specifics, segment specific, what is the earning growth and what is the earning potential. It doesn't mean the in defense sector we directly buy defense companies. It may be indirect beneficiary. There are certain auto ancillaries who also do defense business. They also love those the balance companies are there. It doesn't mean like some of the, like you rightly mentioned, shipyard names. So I won't comment on stocks specifically, but the overall sector is not because of defense. There are some other factors, like there is this shortage of shipyards basically capacity. So shipping capacity shortage. So there are multiple reasons, not single reason. But again, we need to see next 2 3 years, next 2 3 quarters earning growth. Then only I can figure out whether these are justified or not. Because if you see in previous cycle, some of the sectors grown almost 50% in every year, or maybe 4x 5x profit in 3 4 years. So we need to check, and normally investment cycle moves like this. So we just comparing earning growth based on last 2 3 years. So this is not the right way. Probably we need to see few more quarters, and horizon could look, your time horizon should be higher for defense of that. I can make it clear here. So it's choice to choice. Some of the other MCs definitely there is sector in potential. Investor is ready. Stocks are ready. So it also tell you what is the opportunity in defense, because Make in India program government is very clear, and slowly they are increasing allocation, increasing a list of negative items. So it gives you a manufacturing opportunity in general, not exactly for defense companies.
Fair point, and it's a well taken explanation that two things are driving this momentum. One, order inflows from the domestic market, which is of course our defense forces, and of course now this new trend of foreign nations using the Indian capacity to get ships built. The last order on Garden Reach and the one recently on Mazgaon have come in from overseas. Mr. Patil, let's look at some other sectors where a lot of activity has happened, and in one of them is of course the railway theme and the broader PSU setup, which has again shown signs of strong moves coming in after Mr. Modi has been sworn in the Prime Minister for the third time. One, do PSUs, especially in the energy and the railway pack, look overstretched to you, or as the CIO at LIC Mutual Fund, you are still looking at growth to be had in the power space, the energy space, and railway space in particular within the PSU setup?
See, we are bullish on railways, but I exactly can't comment we are bullish on PSC railways or non-private sector railway participants. So, but we see that this is the sector, and those who are beneficiary, and that gives us a valuation comfort, or maybe higher earning growth, maybe higher earning growth supported by PEG ratio. So in booming sector, we need to ignore valuation initially, and then only we see it, and that can be checked by your business visibility. That includes order book and government spending and number of players in sector. So now it's very difficult to answer which one is PSU or private, but obviously both will be beneficiary. It's up the where the investment uh, uh, flow goes. It is directly towards some of the like wagon manufacturing, passenger rails, wheels. There are so many opportunities, and it's also depend on the number of competitors and valuations.
Fair point. In my last 10 conversations with a host of CIOs, equity strategists, and capital allocators. Mr. Patil, I find you the most bullish the most bullish in terms of tone and tenor, and I must compliment you because at this point of time it's really very difficult to sort of find value in a market which is rising dramatically and rapidly on a daily basis. So I'm sure you have a tough task ahead when it comes to allocating fresh monthly SIPs that come into LIC mutual fund. But from now onwards, 24,000 on the Nifty, 53 on Bank Nifty, 80,000 on the Sensex. How are you looking at ideas to deploy fresh capital? What are the 2 or 3 broad themes that you are trying to address with fresh unit holder money?
Okay. Normally we allocate money not on basically looking the basic, not exactly benchmarking the benchmark index. We see the opportunities, and opportunities available. Stock selection is based on opportunity available in the sector and number of the competitors. Let's take a power sector. Power sector is, I think, is a huge opportunity in renewables, thermal power. That includes your NBFCs, those who are funding power plants. Second, transmission. Again, within the renewable, then again, data centers a new theme. So there is an opportunity, and we need to figure out the stock by stock. It is not exactly we want, but we need to follow the again earning growth and valuations are major criteria. But the kind of capex we see for next 6-7 years, still some of the stocks could justify the valuation because let's say a data center is growing by almost 50% every year. So even in power sector, there is a one thing. There is a shortage of power equipment globally in US and Europe also. And in previous cycle, in power sector, majorly some of the equipments we ordered from China and Korea. But this time, because of Make in India compulsion, most of the growth will be captured by only Indian companies. So allocation is higher. You have good export opportunities available, and again there is no major importer. So it is a dot. I can't compare directly with previous cycle, but opportunity is still sizable. Is again depend on the earning expectation and what is the time horizon. But is that there is opportunity? This is a stock picker market. This is not a broad based market.
Yes, I think that's very well put, that it's a stock specific, sector specific market. Although broader indices are also rising faster than the Nifty. As a market observer for the last 30 years or so, Mr. Patil, I find it very difficult to explain to myself the kind of rallies that we are seeing in stocks like PFC, REC. The less said about defense, the better. And of course, the fantastic run-up that we had seen in the PSU banking space. Coming to your major holdings, I'm sure you will not be speaking on individual stocks, but I would be failing in my duty if I don't point out that the top stock in 3 of your large funds that you manage, which is the LIC Mid and Large Cap Fund, the LIC Balanced Advantage Fund, and the LIC Large Cap Fund, is the stock in news, HDFC Bank today. I'm sure you are thrilled deep down that it's your top holding and it's at a record high today based on very, very strong tailwinds. Is this a time, Mr. Patil, where the cycle of inflows is turning in favor of private sector banks as against what we have seen in the last 36 to 48 months, where PSU banks have hogged the limelight? As a capital allocator, how do you look at this possible switch that's happening?
See, it may happen because again, end of the day, buyer has a choice always, and beauty lies in the eyes of beholder. So every fund manager has a different view, and someone want to allocate based on the quality criteria, risk criteria. There are so many factors, and some of the private sector banks are not actually moved up in last 3 years, and so obviously if any institution is a good growing decent pace and within the sector, and country like India is again heading for good days. So definitely BFSI overall segment will grow. Then again, we need to choose within the stocks which one is valuation is attractive, or how much better risk management any institutions have. There are so many factors. So it is not only one factor. Probably valuation, their way of working, and earning growth, what they offer basically.
Fair point. So one would assume that these kind of fresh inflows that are being seen in HDFC Bank, that intensity might not be the same, but nevertheless, at least the outflow will now pause. Mr. Patil, despite your very bullish stance on Indian equities, are there spaces that, as fund manager and as allocator of capital, you are avoiding because you find them overstretched in Indian markets?
Point on sector, because there are some of the stocks fully valued or overvalued within our sector as well. See, it's not like infrastructure space. Every company is we are bullish, because there are certain companies even in defense, infrastructure, capital goods overly valued. So anyway, we are avoiding. But no, as a structurally, we are avoiding at this point of time like commodity chemicals where China is present, metals, because you don't have a clue what's happening there. There is a less business visibility available because of the China slowdown. So normally we avoid, but it is not basically we ignoring or avoiding. It's also depend on what is our capability. We need to understand our capability, what we can do, and what how we can do justice to investors.
Fair point, sir. And which part of the equation do you stand when it comes to these huge block deals? The intensity and the pipeline of block deals is now only matched with the kind of IPO pipeline that we have, and both of them are raising money at record valuations. So promoters are selling, retailers are buying. Is this something that bothers you at night, or this is par for the course as far as bull markets are concerned?
Definitely, we need to rethink so many things, because obviously why someone is selling, and why because when the market goes up, definitely there are promoters who want to exit because they are not seeing this kind of bull run. There are promoters who think because the next generation is not interested. So there are a variety of reasons. The good part is now Indian market is much more liquid, and from here foreign investors have not to worried about the liquidity part. So if you see the large part of the maybe any QIB or I won't name it, but if you see the year on year basis, the size of the overall QIB and IPO is very high, and it does communicate to all foreigners. The India market is growing at rapid pace, and is a still liquid market which offers a lot of opportunity, because if you compare to other developed countries, where promoter holdings are very less, and Indian markets where promoter holdings are relatively higher compared to other markets. So in a way, it's good. It offers a liquidity, and free float market will free float stock will increase. So it's good for someone is coming from outside.
Fine, sir. With that, Yogesh, we'll call it a day. Thank you so much for your time. And of course, I'll keep this intensely bullish commentary that you made in the frontal lobe of my brain. It was a very exciting 30 minutes to listen to your very good views on the broader markets, sectors to avoid, sectors to tap in, and of course, the wonderful discourse on the defense industry. Thank you so much for your time, and it was a pleasure to host you.
Thank you very much, and pleasure talking to you.
This, ladies and gentlemen, was Mr. Yogesh Patil, the Chief Investment Officer for the equity business at LIC Mutual Fund. He manages over 5,400 crore rupees spread over 5 schemes and has an intensely bullish view about Indian equities. Thank you for watching us, but remain glued to Business Today Television for all that is there to be updated in financial news, markets during market hours, and of course after that too. Stay glued.
All right, Toyota's Vikram Gulati joins us for a quick chat at ISA. Thank you so much, Mr. Gulati, for joining us, sir. Toyota has been at the forefront of getting a lot of green vehicles into the Indian market, sir. In fact, when Mr. Vikram, Mr.